Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me here in the studio is my friend and colleague, Niklas. How are you?
I'm great today, as we have the great pleasure of talking to Matt Joass, the founder and chief investment officer of Maven Funds Management. We got in contact with Matt thanks to our friend and loyal listener, Alan, which you might know from Twitter as Partnership Investing.
For today's episode, our guest has selected the book Superforecasting, The Art and Science of Prediction, written by Phil Tetlock and Dan Gardner, and the book was published in 2015. Here comes our conversation with Matt Joass. Welcome to the podcast, Matt, and thank you for taking the time.
Thanks very much. Happy to be here.
And where are you today?
So I'm in Brisbane today. So yeah, I've been living in Australia for a few years now and just moved up to Brisbane recently. So moved around a little bit, Sydney and Brisbane. Lived over a bit near you guys for a while over in Copenhagen, Denmark. But yeah, in warm, sunny Brisbane at the moment.
And how did you get started with investing?
Got started with investing. I think I was interested in business from a pretty young age. I'd read a book, which I don't recommend, called Rich Dad, Poor Dad, which got me interested in that as a young teen. And that, I think, so basically as soon as I turned 18, I started investing once I was allowed to legally open a brokerage account, but had no clue what I was doing. And finally later discovered some other books, one about Warren Buffett, which kind of got me onto the correct road. But yeah, I guess I grew up saving and interested in business, but that was, one book to get me interested and one to set me on the right path is kind of how I think about it.
And which book was that?
It was actually a pretty simple one. It's just how Buffett does it. It was like a pretty, basic one, but it just kind of lit that spark. So I'd started investing when I was 18, but I was, like a man without a map, following the blind, I guess, learning from other people on stock forums, which, back then maybe, I don't know if they're any better now, probably not much better. So I had, a lot of interest and energy, but I just kind of thought investing was about trying to, get some news or find something hot, and didn't really have a kind of philosophy to hang it on. And so, discovering Buffett kind of, that was when it started taking over my life. That was around when I moved to Copenhagen, and I was here before my partner arrived, there before my partner arrived for a while. So I had the long Danish winter just to become obsessed with investing, and read a whole lot more books, Snowball and everything else. And that was kind of when I got the bug of investing.
And how come you moved back to Australia?
So originally from New Zealand, moved to Denmark for a grad program. I think out of uni, I wanted to see the world, international business. So it was kind of an opportunity to be an expat for a while, which is really cool. But when I was there, as I said, it started taking over my life. Literally nights and weekends, that was all I would do. Started an investment partnership with a friend, started a Copenhagen Investment Club on Meetup. And so I basically realized this isn't, I was, working in finance for a big shipping company. It was interesting, but it wasn't like my passion. And I had an opportunity. I started writing for the Motley Fool Australia. I had an opportunity. They were hiring an analyst to move down to Australia, kind of take a new adventure. And that's how I ended up moving back down to kind of pursue the dream, I guess, of investing professionally.
And fascinating how books can change the course of your life, as you mentioned.
Yeah.
And today you have chosen the book Superforecasting. So why have you done this?
Superforecasting is one of my all-time favorite books. I kind of consider it like a foundational book for me in my investing, but it's how to think about investing. So there's a lot. It's not actually an investing book per se. It's a thinking book, I'd say. But it's how to think about all the difficulties of investing, and it gives you that framework. So there's a lot in the industry that's kind of anti-forecasting, and I think they address it quite early. We can get into some of that a bit later, but it teaches you first and foremost that it is a learnable skill, something that you can develop. And I think it's really to the core of everything that we do in the profession, and frankly, a lot of our lives. And it really breaks it down. It's like the best book I've come across that's a combination of like deep academic and practical research, but then with like handy, useful, practical tips. Like it's that combination that I think is really interesting. And it's just one I'm quite passionate about. I get fired up in defense of forecasting, because I think it has a bad name for some fairly good reasons that we can get into, but it's really foundational to me and how I think about how to invest.
And the authors of the book are Phil Tetlock and Dan Gardner. Can you briefly tell us about them?
Yeah, so Phil Tetlock, I think he opens the book, it's on about page 5 or something, and he kind of talks about, it starts with a joke. You might have heard, the joke about the dart throwing chimp being better than the expert. And he kind of goes on to say, like a researcher studied all these experts and, found they were no better than chance. And he says, that's not actually what people say, though, because it's not funny. So they say it's no better than a dart throwing chimp. And then he says, I am that researcher. And this is a book like about forecasting, right? So it's kind of interesting. He's the guy that did that research. So very accomplished academic at the University of Pennsylvania, I believe. And he basically, his kind of first book was Expert Political Judgment, where he'd studied a few hundred experts making thousands of predictions for about 20 years. And that was kind of where this view came from, that the experts weren't very good. But he opens a book kind of saying that was misinterpreted or basically taken out of context in some ways. Like some parts of it are true and some not. We can get into that. So very smart guy. If you watch any YouTube videos of type in Superforecasting YouTube, you kind of see him talk. You can see he's very rigorous and thoughtful in how he approaches things, which I quite like. Partnered with Dan Gardner in this one, who's partner kind of background as an investigative journalist and had written a book, frankly, which if you read his bio, this earlier book is basically saying the same thing. I think in the description, it talks about how experts aren't very good and are like dart throwing chimps. So I'm not sure how the collaboration happened, to be honest. That might be an interesting thing in its own, but that it's maybe to make a more accessible book, because Expert Political Judgment is kind of a hard read, but Superforecasting, I think, is a very easy read to understand it. That's, I think, how they came together.
And why are people in general bad forecasters?
Yeah, I mean, I guess I'd push back. So first, we have this idea that people are bad forecasters. I think we're the best. We have to say compared to what and in what context, because humans are the best forecasters in the known universe. Like in terms of general purpose forecasting, that's the base of what we do. There's some, the leading kind of science of theories in neuroscience point to the neocortex basically being a prediction machine. It builds a model of the world, or thousands of different models, and then can, forecast what's going to happen. And then if something different happens, then it, gets a jolt and it hopefully learns or chooses another model. It's really the core of what we do. And I think what the idea that people are bad forecasters is when we start getting into domains that are difficult to forecast. So, we're excellent forecasters in science, right? Like science is basically just forecasting. We make a prediction, we test it. But if we're thinking about complex adaptive systems, so kind of human systems, and we're thinking many years out, these are extremely complex domains. And so there's kind of a limit to how far you can see in the future. Superforecasting talks about maybe 18 months is kind of the upper limit. And some of his prior research was more in that 3 to 5 year mark. And that's where some of the problems were. But I think there's a lot of other things laying out. We just haven't really tried before. Like we have the idea that we're bad at it. And so, no, it's not a science. It's like, and they talk about this in the book, the medical profession a couple 100 years ago, it'd be like, why are humans bad doctors? And you'd see a lot of evidence if you looked around when there was bloodletting that people were bad doctors. But it turns out we just didn't have the right approach. We hadn't tried yet, basically. And once you got the scientific method into medicine, you had the medical revolution of healthcare. So, I guess I push back on the idea we're bad. But I think that the reason that there's a lot of bad forecasts, because there are bad predictions out there, is we're not incentivized to do it. We haven't tried. And the people that are typically pundits invited on television, I've been on television a few times. It's definitely an incentive to say something really emphatic, to say it with 100% certainty, to not be anything wishy-washy. This is the opposite of good forecasting. Good forecasting is very thoughtful. It gives a balance of probabilities. It's not deterministic. And it's kind of the opposite of what makes good TV. So we haven't tried. We're selecting actively for bad forecasting and the types of what we want for punditry and entertainment. And we haven't measured it. So we don't hold anyone to account. So I think those three things kind of explain what is bad about a lot of macro predictions. I agree with the general, a lot of macro predictions are terrible, but it's more the state of where we currently are than where we could be, I think, if we applied some of the lessons in this book.
And I mean, considering forecasting is at the heart of what we do as investors, I'm curious to know what you've learned from the book in terms of becoming a good forecaster and how it has helped you to improve your investing process.
Yeah, I think it's a constant process. So it kind of permeates everything that I do and what we try to do. So they give a lot of descriptions in the book about the attributes of a good I was going to say good investor, a good forecaster. I think they're the same thing basically. If you read through it, it's all the stuff that Charlie figured out, Charlie Munger figured out, and Warren Buffett figured out. It's with rigorous science. So the way that I try and apply it is thinking through everything probabilistically, thinking through what they call the outside view. So thinking about base rates before you get into the specifics. It's actually really relevant too to the style of investing I like. So I'm kind of biased towards fast growing businesses. It's just what interests me. Personally, I like technology and change. I'm still a value investor, so I think there's that classic false dichotomy between value and growth. But I think there is a bit of a spectrum there. You have one end of value investing, which is mature businesses that are very predictable, and you have the other end, which is early stage businesses. And so the more you move towards early stage, the more your terminal value, the more the future matters if you're going to value that business. And so that's how I try and bring it in, basically, is breaking down our thesis of what we own into forecasts and just thinking through the probability weighted outcomes of what we're trying to do. I guess overall it's how to think at like a high level, and then there's some kind of practical tools that follow from it. But so that's the first. And then when we bring other people into the firm, it's looking for those traits that they talk about. So open-mindedness, the kind of catchphrase of the book, I think, is that what was it? Beliefs are hypotheses to be tested, not treasures to be guarded. So trying to just find people who are already like that, because it's really hard to change someone's kind of DNA if they're not like that, and then just trying to build a culture that enforces that. So yeah, that's the high level. It's like an entire lifetime to master that process, but it's just kind of beautifully laid out in my view.
And about the thing you laid out about that you can actually improve as a forecaster, not all are as positive as you are about this. And I mean, two examples of that is Daniel Kahneman and Nassim Taleb. What is their critique about?
Yeah, so there's a couple of things. I wonder if Tetlock has them in mind. There's a great quote that he has in the book about how his work got skewed. And I think he talks about, what was it he said? My research has become a reference for nihilists who see the future as inherently unpredictable and know nothing populists who insist on preceding expert with so-called. So I think he's like a bit affronted by it, but there's kind of a couple of things to pick apart. The first is our language, right? So we talk about forecasting, and a lot of what people mean by that, I would say, is more like spot prediction. So prediction is, particularly spot prediction, is you're predicting a thing that's going to happen. Like I say, Russia will invade Ukraine, or Russia will not invade Ukraine, or this thing will happen. And that's just not possible to do unless it's 100% probability. We should be forecasting that range of probability. So I think a lot of what people see as bad, like we shouldn't forecast, is actually saying we shouldn't predict a specific outcome in an uncertain future, which I completely agree with. That's like the whole basis of super forecasting. So that's one. I think there's just this inherent sense from those two critics that it's something that is not doable, or if it is doable, it's not useful. Like Taleb talks about black swans are all that matter, but they kind of address that in the book again, that you can make a black swan more of a gray swan if you understand at least the probability estimate. So you're not trying to predict that there will be a global pandemic, but you can say this is a 1 in 100 year probability. So as a base rate, we should at least expect a 1% chance each year. And people were saying this, as people talk about it's unpredictable. Kind of Bill Gates a couple of years ago had a major keynote where he's like, we should be preparing for a global pandemic. It's been about 100, so I think that there's some, it's mixing things up, basically. It's mixing up the bad pundits on TV. It's mixing up spot predictions with a range of outcomes. Because I've never heard someone say you shouldn't think about the probabilistic future and like probability weight your estimates of events, and then act accordingly. That's a hard thing to argue against because it's so rational and reasonable. But there's a lot to, if you create the straw man and I don't even know if they realize they're doing it. I read Howard Marks' recent memo, and I was kind of taking notes as I read through it, in part preparing because I knew we'd be chatting about some critics of forecasting. And everything he's talking about, I was noting, is deterministic thinking of the world. So deterministic world means you think like a clock, right? It's completely predictable. If A equals B and B equals C, then A equals C. The world that we forecast isn't like that. And so all of his criticism was about how the world isn't deterministic. But that's very addressed in super forecasting. We need to understand it's not a deterministic world. That's why we have a probabilistic world. And I think that kind of sums it up, I guess, is the main thing. Kahneman's fairly pessimistic in general on human abilities and foibles. And I think that's one. Maybe one last comment on it is this is super forecasting. Like, it's not easy casting, right? Like, it's what he found was, although the forecasters were kind of better than chance, like the people who volunteered and were already kind of smart and interested, there was only top 2% that were super forecasters able to really outperform about 60 to 80% better than the control. So that's still, if you're going to take the average, if you're a person used to taking the average, maybe the average is still not that interesting if they're only 20% better. But the point is that you can become better, and we haven't really tried yet. And yeah, there's these super forecasters, the top 2% that are meaningfully, usefully better.
Probably similar to the distribution of good fund managers or investors, right?
Yeah, well, exactly right. And I think, it's that kind of power law distribution. I think that there'll be a very small kind of chunk that add enough value. And yeah, I'd agree. I think that's the way to think about it. Or the startup of a new company, right? If you're starting a company, if you just looked at the averages, you'd never start a new startup because almost everyone fails, but the few that make it, it's so valuable. So yeah, I think that's a good framing.
And when it comes to improving as forecasters, the authors really help us by ending the book with this practical summary, what they call the 10 commandments. So can you tell us a bit about these ones?
Yeah, so we can chat through them. So it's super helpful. You're kind of like, I take a lot of notes through a book as I'm reading it, and this one you get to the end, it's like, they've already summarized it all perfectly. But yeah, so the 10 commandments, and I think they have actually 11, which is great, because the 11th one is basically don't over rely on commandments. So the first one is triage. So that's basically deciding which problems are forecastable. So don't waste time on super easy forecasts that are just what they call clock-like. Like, if it's deterministic and easy to predict, don't waste time on it. But likewise, if it's incredibly complex, cloud-like, if you're trying to predict the GDP in 100 years' time, don't waste time on that either. So focus where it pays off. Break the problems down into sub-problems. So you might not be able to forecast when the Ukraine war will end, but you might be able to forecast more specific things like how much more funding will Ukraine get, et cetera, et cetera. Striking a balance between inside and outside. I think starting with the outside view is really important. Something that as investors, we're always drawn to the inside view. So thinking about specifics of the company. A lot of what they talk about is balance. So they use the analogy of riding a bike, like don't lean too far left, don't lean too far to the right.
Sorry, Matt, can you just speak a bit more about the inside-outside view so our listeners really grasp that?
Yeah, so when we're looking at a company, especially if you have to choose your path to understanding the company, I think. So if you're coming at it from the company's presentation and a charismatic CEO, then you're getting the inside view, which is the company-specific view or the event-specific view. So it's kind of why this company is so special and so great and everything they'll do is amazing. The outside view is looking at all similar examples of that instance that have gone before. So if this is a cash-burning early-stage tech startup, you should look at what's the base rate, the average rate, what's the typical performance from that group, and start there. And that kind of, if you have to choose an anchor, that's kind of the argument you make. You will anchor anyway, because anchoring is a bias. So it's better to anchor at a level that is at least informed by base rates, and then moderate that up or down. So if you know that only 5% of early stage money burning startups go on to become successful businesses, that should be where you kind of start if you're thinking about probabilities. And then maybe this one's really great and they've got all this other stuff, and maybe you get up to 10 or 15, and that kind of puts it in perspective. Then you're saying, I think it's 3 times better than normal, but it's still only a 15% probability or whatever. So that's the outside and inside view, and it's really easy to jump to the inside view. It's all these things. I don't claim to be perfect at any of this. This is a constant process. But that's how I see the outside and inside, and starting outside and working your way in. Yeah, maybe. And so the next one was the balance of underreacting and overreacting to evidence. So I think you had a good line: belief updating is to good forecasting as brushing and flossing are to dental hygiene. Boring, uncomfortable, but pays off in the long term. So it's tough to reconsider your beliefs, and I think that you need to constantly want to do that. It's very easy. Your brain spends a lot of time training a model. And once it's trained a model, it really doesn't want to shift off to a different model. That's one evolutionary kind of driver for it. And so when you find some disconfirming evidence, it's very easy just to stick in what you're already doing. So if you can find a way to adjust to that, counteract yourself, but not too much, then that can be really powerful. The fifth one I really liked was looking for the clashing causal forces that are at work in each problem. And this is really important because, like, if you tune into Twitter and some of the YouTube interviews of doom and macro stuff at the moment, we've all got the bad causal forces that can happen, right? But it's very hard to talk about all the good causal forces, which is basically like 7 billion people are currently working to better their lives. And what flow through does that have? So I think that's one for me. It's very easy to be salient of all the causal forces going in one direction. The Chinese economy is one. It's easy to think about all the debt and not, everything else that's pushing the other way. So I think that's quite an important one. Strive to distinguish. This is kind of a controversial one, I think. Strive to distinguish as many degrees of doubt as a problem has, but no more. So it's basically saying nuance matters. So it's better to forecast a 55 versus 45 probability than 60-40. It's better to go more granular. And that kind of flies in the face, I think, to a degree with some wisdom, where there's a lot of view that investors have that it's better to be, roughly right than precisely wrong. And I think that that's true because there's so much bad modeling to hide, a lack of knowledge basically in investing and relying on a model too much. But it does show the best forecasters do have granular views of the world. So I think it's something to be cautious of, basically, not trying to dumb down your thinking too much. Try and be as specific as it needs to be, but no more specific. Kind of stuck out to me as, again, one that kind of goes against the grain of what conventional wisdom is for investing. Again, striking the right balance between underconfidence and overconfidence, looking for the errors behind your mistakes, but again, beware of rear view mirror hindsight. Do postmortems. Another one that I really like is to look at your successes. So not just postmortems on failures, but postmortems on successes. That's actually one that David Gardner. So after I discovered Warren Buffett, I was influenced a lot by David Gardner at the Motley Fool, who's the complete opposite in a lot of ways, hyper growth, multi-baggers. But that's something that he had always said is, I focus on my successes because that's where I make the money, which I think is really interesting. Bring out the best in others and let them bring out the best in you. So it's perspective, basically trying to build a high performing team, try and authentically reproduce the arguments of the other person to their liking. I think that's a great way to start framing a debate, to stop it pulls you out of it being an ad hominem attack and one-on-one kind of our lower brain ego fight into a more thoughtful discussion. Being really precise with your questions, constructive confrontation, that kind of thing. The 10th one was mastering the error balancing bicycle. So basically each of these he's talked about is like riding a bicycle. Try and, think through how to balance out these opposing errors. And that's a big one because it's not a book where you can just read 10 points and just go easily implement them. You have to constantly balance all of this through your life. And I think of the best investors, when you talk about Stanley Druckenmiller, he talks about a lot about when you're hot as investing, he likes to put on more risk. Again, he's more of a trader than a lot of, at least me as an investor, but I think that's probably what is happening. I think he's probably finding he's really in balance on the bicycle, and that's the time that he pedals hard. If I was going to, apply that thinking here. And the last one, which I love, 10 commandments. The 11th is don't treat commandments as commandments. Kind of constantly be updating your thinking. And I kind of like that's a good way to end the Superforecasting book. Is it's not a Bible, guys. You have to constantly update. We're scientists. We're trying to improve the field of human knowledge of what we're doing. I think that's a great way to summarize at the end of the book.
And we're curious to hear how you use all of this in your work as a money manager. But first, we can talk a little bit about your firm, maybe Maven Funds Management, where you are the founder and CIO of. And some of our listeners might come to think of Malcolm Gladwell's book, The Tipping Point, when they hear Maven and Mavens. Can you tell us a bit about this?
Yeah, for sure. That was the inspiration for the name. So, in the Tipping Point, Gladwell identifies this group of mavens that are kind of critical to the idea of the spread of a new idea. Trusted expert kind of seeks out knowledge and then shares that with others. And that's the big driving force for what motivates me as an investor. Before starting Maven, I worked for Motley Fool, as I mentioned, joined as research analyst and then portfolio manager for a service that they had there called Motley Fool Pro, and kind of ran that. Well, it was 4.5 years there, partly as research analyst and then as portfolio manager, and kind of thought I'd leave there and just manage my own money to a degree, and maybe some friends and family, and had a lot of the former clients reach out. They'd had a lot of success. People were giving money back to charity, and we had one gentleman who, built some houses for people in Mexico, and it was kind of a tipping point for myself, I guess, is thinking, what do you want to do with the rest of your life? I had some friends who had made enough money to invest independently, and a lot of people, I shouldn't say it's too much my friends who's listening, but a lot of people end up in their sweatpants in the lounge and not really, they find like the meaning kind of vanishes pretty quickly, I think, after you get out of working with other people. And that's what interests me the most, is working with other people directly and also with our investors, our co-investors, and kind of sharing knowledge with them and getting their thoughts on things back in return. So, I had an investor email me just the other day talking about what, some Chinese factories that he's aware of are doing. And it's just, that's what interests me. So that's the idea of Maven, I guess. We're trying to master the craft of investing. And I guess if anyone's listening to this and they're interested in the idea of super forecasting and how it can be applied, I'd love to chat and swap notes. We're very open to that. So that's the idea behind Maven. In terms of how we apply it, I think it's breaking down all those components. We can get into some specifics if you like, but thinking about how we can break down everything that we do into a forecast as much as possible, and just the kind of philosophy of how we think about investing and decision making.
And firstly, how many are you at Maven, and what is your strategy when it comes to investing?
Yeah, so our focus is Australian and New Zealand. We're basically trying to master that market. We tend to invest in global companies that are based here. And the reason, putting this together was pre-COVID, when it's hard to travel, or before everyone had Zoom, basically, where I was thinking, okay, we're starting off, we probably want to do something where we can meet with CEOs, because we like to meet with CEOs directly. But the strategy is basically trying to find these, what you might call like a right tail winner. We'd call them monsters, but these small companies, they have the ability to grow to be very large. Finding them when they're early enough that we think we can value and forecast them, but not so big that most of the gains have already been had. I guess that's the sweet spot of what we're trying to aim for, is trying to catch those right tail events as early as we can, as many of those as we can find. But the positioning kind of is between Warren Buffett and David Gardner. So everything's always driven by valuation, but it's a range of opportunities that we can see in there. We're very happy to own something that's deeply undervalued and spewing cash, and maybe growing modestly. That's possible if it's undervalued enough, for sure. But I think a lot of investing is it's not like a independent thing of what the best approach is. It's what's the best approach for you. It's trying on like a lot of different styles to find what suits your temperament and interest. And I guess our interest is focusing on technology and change in those moments where things are very different from the recent past, what we'd call like a fundamental inflection point. So the future is very different. And there's 3 of us at the moment, and potentially expanding the team, but pretty small team. We won't be growing to be a massive team. I think one of the advantages, and something they talk about in the super forecasting, is the importance of a cohesive small kind of team, and making sure you don't get groupthink and all those other things going.
So now I'm really curious to know a bit more about your investing process and how the framework of super forecasting have shaped how you work. And it would be really interesting to hear if you could talk us through maybe a stock that you own and and how you've used the framework when first buying the stock and then updating your views over time.
Yeah, we try and incorporate it into the whole process. So when we're it's not just for the ones that we own either, it's ones we don't. Often for the ones we say no to, we try and put a forecast in there and then track that forecast. So we have a little system set up so we can forecast the reason, typically tied to the reason that we're saying no. For instance, we think this company's only going to grow active users by 10% or whatever it is, and then we can track that in a year's time when we'll have those figures. So it kind of we try to have it permeate as much as possible. The process is really deep into what we do. In terms of specific, probably one of the best examples is Cogstate, which is a neuroscience or cognitive testing company, and that's one that we've held for quite a while. It has performed very well from our first position. We started with a very small position because we didn't have enough. We didn't see a high enough probability, basically, of success at that stage. But it's an interesting one from this perspective of forecasting because it's got a kind of solid core business, but it's also very tied to the outcome of things beyond its control, which is basically having the first Alzheimer's drug on market, which means there's a lot more demand for further Alzheimer's research. They're kind of like a picks and shovels play on Alzheimer's drug research. They provide the clinical trial software and smart PhD people to help run the clinical trials to test people's cognition, see if it's improved over time. And they have kind of two opportunities to benefit from a big boom in Alzheimer's research, if and when it comes. One, that they do those trials, and two, they've licensed out their software for ASI, one of the big pharma giants, to use as a screening test, which, if successful, again, thinking about probabilities, but if successful, could be a game changer, kind of tens of millions of market of very high margin revenue in a company that, would dwarf the current business, basically, if that happened. And so the usefulness of something like Superforecasting is, investors tend to think of that as a coin flip, or they won't own until it's sure that it's going to happen. Or sometimes if we're in a speculative mania, they'll just own it because there's a potential for it to happen, right? Like if we're thinking about some of the electric vehicle stocks a little while ago. So it's kind of trying to step between those two and actually put some numbers around it. So so I try to break down different parts of it, like will this drug have a successful outcome at this at the stage 3 trial, for instance? Will it be funded by the CMS? Will it be approved by the FDA? And then think through the base rate. So looking at what percentage of drugs is this a good base rate? Because the other interesting thing about what we do at an inflection point, and this is what Howard Marks talked about as well, at an inflection point, the past kind of becomes irrelevant to a degree. And that's because there's a change, right? So the first Alzheimer's drug that's ever approved is the first. There's no basis for that in the past. And that's where you can have these massive kind of re-rates in the market's perception of things. And so we're kind of on the cusp of that now, potentially. So lecanemab is just had very positive phase 3 trial results. We'll find out in the next 6 to 9 months if it's going to be the first major new drug that's approved. And so, that's kind of how we think about it. Start from that base rate of no Alzheimer's drugs have been approved before, no disease-modifying Alzheimer's drugs, and then kind of work up from there. And now we're starting to get more and more evidence, actually, this one is likely to be approved. And as we started incorporating that into our valuation, I don't think the upside's in there. And that's kind of how we can have a margin of safety sometimes is, the existing business as it ticks along is, probably slightly undervalued, probably around there, but there's this huge upside potential that's kind of the margin of safety, or the upside to that investment case.
And coming at this from a sell side point of view that we have as analysts, we're also covering a lot of life science companies and dealing with these kind of base rates and probabilities. But like many investors, our opinion at least is that they don't really grasp that it's a probability game, and it's a lot about understanding the assumptions and have this scenario analysis that we have, base case, which is like the most likely scenario, but there's also a bull case and a bear case. But many people are, when they are looking at analysis, they are often like focusing on one number and one valuation. And what do you think about that?
Yeah, I mean, that's the human condition, right? It's like, don't give me these probabilities. Tell me what it's going to be. What are we paying you for? That's the whole thing. In Superforecast, a speech that you can find on YouTube if you look him up, Phil Tetlock a quote from the movie, I'm forgetting the name of it, whether it's SEAL Team 6, but about the hunt for Osama bin Laden. And there's this kind of scene where they're in the room with the CIA and the notional CIA chief. They're saying, I think it's a 60% probability that Osama's there. And everyone says a 60. And he's like, oh, what is this? This cluster. I won't swear on your podcast. And what are you people saying? And then this analyst comes in and she says 100% probability, 100% he's there. He's like, brilliant. You're the one. And she's the hero of the movie, right? But that's terrible forecasting. It's not 100%. There's no way it was 100% before going in. And I think we're just drawn to that as humans. It's political leaders as well. Leaders, we're drawn to people that are incredibly high conviction. The reason that we're crazy people often are in very influential positions are because they have a complete conviction in what they're saying. I won't name any celebrities. I'm not sure if I'm going to annoy Kanye or something like that, but that we're drawn to that high conviction. There's something about us that we find it fascinating, and it maybe soothes our uncertain world to see someone like that, but it's just not how the world works.
Yeah, the authors are really hoping for an evidence-based forecasting movement, as they put it. What do you think about that? Is there any hope for that?
I definitely think there's hope. I think you see it even in some sell-side, there's some younger, smart sell-side guys, perhaps like yourselves, who are starting to incorporate this, and you see more talk about probability ranges, right, when they're doing estimates. I think it's starting. I think maybe prediction markets and maybe some more smart stuff around that will probably be what drives it a bit more. But yeah, just unfortunately, these things take a bit of time. Hopefully, podcasts like this get the word out on it. It can really improve society, I think, if it gets adopted. So the challenge is at the moment, the entertainment style doesn't suit it. It doesn't speak to our deep animal side of our brain. So we need to find a way to get both across. I think create a tournament that people are also very interested in, the nuanced views.
Well, for us as investors, it's quite good actually. For now, we still have an edge, I guess.
I've thought about that, to be honest. Should we really try and correct people about this? It's kind of a pretty big deal. That even very big successful investors, as I said, Howard Marks was, I think, he's kind of not thinking the same way about this. Obviously, he's an incredibly successful investor I learned a lot from. So I think there's something to that. But at the same time, yeah, it's hard. It's not an easy thing to do anyway. So yeah.
And one of the commandments you mentioned was to break down an original question into smaller parts. And considering that as an investor, we talk about should we buy, should we sell, but there are really tons of questions into that. It's not just a buy or sell. Can you maybe describe that a bit? How do you incorporate this, and how do you come up with good sub questions to the main question, so to speak?
Yeah, this is something just coincidentally. I took a course at university on the philosophy of logic, I think it was, kind of a formal logic class, just out of interest, basically. And it kind of taught that basic framing of how to break down an argument into its premises. And, you can have two types of arguments: deductive, where if the premises are all true, then the argument is definitely true, like A equals B, B equals C, therefore A equals C. Or inductive, which is kind of the world that we're in, where we're thinking about the probability of the premises. And so I kind of had this idea before Superforecasting when you're thinking about it in a stock thesis, break it down into premises and sub-conclusions, and then those sub-conclusions are themselves the premises for the total conclusion, the final conclusion. And so that's kind of a view of how I try and break it down, which seems to be a good approach in Superforecasting view. So that's basically what we try and do. Try and break it down into a series of premises, P1, P2, P3, then the notation for it, which would lead to a conclusion. And that gives you something that you can track and something that you can forecast and measure yourself on. So, it depends on how you go about that, depends on the business, but you want it to be something measurable. You want to be as specific as possible, not like, will this company have good morale? You want to have a way to measure it, however you do it. And yeah, try and combine those back up. And I think that it makes it a lot easier. It's hard to do to start off with. It's not actually, because you're not used to thinking that way. But yeah, I think that, along with writing out your investment thesis, and then go back through it and kind of break out what are the few premises of this argument and what are the sub-conclusions and what are the conclusions. And you can often strip out just parts where that doesn't make sense. Like that doesn't imply that just because, it's grown revenue, it doesn't imply that it's, I don't know, whatever, high return on invested capital. So yeah, that's kind of how I try and break it out, is how specific can we get the premises? Can we test them? And then the testing part's quite fun. It's talking to other people who used to work in the company, experts and stuff, and you have a more targeted game of what you're going after when you review the position. Yeah, and I think the other thing with investing is, you're completely unbiased and rational up until the point that you buy, and from then on you have the endowment effect to contend with. So I think it's a good way to go back, when you get some news on the company, whether good or bad, and kind of evaluate your premises and conclusions.
And if when you go about updating your original view, as you said, I mean, for example, have you seen a pattern where you have incorporated some kind of catalyst that will really change the thesis from, I mean, either the positive or the negative? And how do the market typically react if that happens? Is it underreaction or overreaction? And yeah, maybe you can speak about that.
I mean, it's a great question. I think you kind of want the market to not react often, right? Because then the beautiful thing is you're watching this catalyst, you get to buy on the reaction, and that I think is where you can have the most alpha. There's definitely been some where I've been waiting and thinking this catalyst, and it turns out there's so many other people looking at it that it just shoots up. Cogstate actually recently just shot up significantly on these results, but now it's coming back down, and maybe people will get a bit bored of it. Markets aren't, not much is happening. And so, that can be another opportunity. So yeah, I think it just comes back to the valuation test, basically, right? Like that's always my foundation. It's kind of the North Star to stop me getting lost, is how much does this actually change the valuation? Like we're not just doing it's not just a prediction tournament. We then tie it back to the valuation. How much does this change the, discounted cash flows we expect to get? But yeah, this is the craziest time in the history of investing. I feel like Stanley Druckenmiller has said, I've studied hundreds of years. He's like the greatest investor of all time, particularly in macro and trading. And this is the most uncertain time ever. So I think you have to be aware of kind of fake outs. And at least for me, not having too firm of a view, like whether it's inflation or whatever. I'm very, I could imagine inflation falling off for a couple months and everyone getting massively faked out that way, and then it coming back as we have an energy-driven inflation again. So I think it's just, for me, being open to the vast array of possibilities and trying to adapt it each time, and again, try and step back and make a good forecast at the moment.
Being pragmatic, I think we talked about that with Robert Hagstrom.
Yes, yeah, that's the approach. I don't know. How do you guys think about it in this age? It's a pretty weird time at the moment, right?
But it feels like we always say that this is such a strange time. We cannot predict anything. I mean, it's so uncertain, everything. And then with hindsight, it's like, it turned out in a specific way. And then there are always reasons for it. So
yeah, it's tough. I think, I mean, I agree to a lot what you said. And I think just try to keep track on things that's happening, and I mean, just because everything seems to change all the time, it doesn't mean that you should stop. You should still try to make your best forecast of what's happening and so on, and I think that's the way to go.
Yeah, I think it comes back to one of the concepts in this book about growth mindset versus fixed mindset. What are your thoughts about that? Maybe you can explain the concept for our listeners.
Yeah, I mean, that's a huge one. I had for a while on my wall, win or learn, which basically that concept. So a fixed mindset, you believe your abilities are fixed and the outcomes that you have in life are kind of predetermined. Growth mindset believes that you can change that, and I think the more that you can have a growth mindset about any endeavor, the more successful you'll be. Like there's a lot of research on that. You'll be more resilient. But it's also interesting that we're not like one thing, and we're on a spectrum, and we're on a spectrum with regard to different activities. Like I was thinking it through, I probably have a pretty fixed mindset, or I had on my ability to draw. And so I'm just like testing that with some book drawing on the right side of the brain. But when it comes to investing, the growth mindset means that you think that you have the ability to become better. When it comes to forecasting, I think that's again why this book is so powerful, because it instills a growth mindset. It says, that a mistake is an opportunity to learn and get better. It doesn't mean you're, doomed to be like this forever. And yeah, you just reminded me as well of the difference between foxes and hedgehogs. That was some of the research that you found. That's something that we see a lot of at the moment, is this people who have one mental model or a couple, and they use that to examine the whole world. And those, again, that gives you a lot of conviction when you have that. In these uncertain times, it's very easy to find someone who's like predicted the Ukraine war or inflation, and they have one model, one lens to see the whole world. But it's a really bad way to go through life, because there's sometimes that lens applies and you should use it, and there's a lot of times where it doesn't.
And those are the hedgehogs.
Those are the hedgehogs, exactly. Yeah. So what you want to be, I think, is a fox, which I think a lot of generalist investors will probably like hearing, but a confirmation bias for us. But you want to be across a lot of different domains of Charlie Munger's mental models. You want to find the mental model that best fits the domain. I used to think of mental models as like this abstract concept, but again, the latest neuroscience research, which is in a book called 1,000 Brains that I really liked, indicates that our brain is literally just the neocortex, at least, is a competition between thousands of models. Like, it's literally mental models, like all the way down. Our vision is mental models, etc. And so I think that's it. You just want to find ones that fit the scenarios best. All models are wrong, some models are useful, and that's the way to frame it. There's plenty of authors at the moment who have one lens, and I think it's good to learn from them. There's Peter Zeihan, who just uses geography and demographics. That's not a lens I've ever used. Like, I never normally thought about geography influencing the world, really. Like, the world is flat, etc. But that's actually an interesting lens to put on, and then think about how it affects businesses and countries and everything else.
And what are your most common cognitive biases, would you say?
My most common, I think I have like an extremism bias, probably. So I can see very pessimistic scenarios and very optimistic ones. So I loved history as a kid, partly because of how different the world is. So I'm probably a bit prone to that. I think if I think back over the last couple of years, I kind of thought COVID would change more things than it did, for instance, and kind of ignored the inertia that we all have to anything new. And so those are some things, but a whole litany of plenty of other cognitive biases that I'm constantly trying to manage.
And is there any investing example where you have tried to use like the Superforecasting framework, but you didn't succeed?
I think there's lots of examples where I don't succeed in investing, but it's not really coming down to the framework being wrong. I guess it's, again, just it's kind of like saying where you tried to use value investing and it didn't work. It's kind of like it always works if you can do it right, if you can value the business properly. I think the most recent, though, as I mentioned, was during COVID, my probability estimates were just off for how much some things were going to change. I kind of saw this as a crossing the chasm moment for a lot of technologies, where they were finally going to get from, not really mainstream adoption into mainstream. That kind of happened for a couple of things, like Zoom, frankly, like that jumped across the chasm. But a lot of other stuff we've kind of snapped back to. Maybe remote working is another one. And so that's probably one recent one where I had a view of the world, still thinking probabilistically, but my weightings were off, essentially. So that's probably the main one that I can think of. The other just constant thing is making sure you don't have thesis creep. So just holding yourself to those premises and not tweaking anything. But again, that's where I think it can be useful to do it. And
how do you avoid thesis creep?
I think just being really specific on what your thesis is when you get new information. A lot of people talk about a process for investing, and if they were writing it out, they'd have a really great process. Like if you talk to a lot of investors today, like we're all kind of pretty well networked on FinTwit or whatever, there's a lot of people you talk to would have a very similar idea of what they're looking for in a good company. And I think a lot of the difference comes down to execution. So it's making sure you don't just keep the idea up in your head, and that you keep doing it. I think a lot of people are good at the start of a new position, for instance, where you have an idea of why you own it, but you need to keep updating the premises of that model and the conclusions. So that's the way to combat it, I think, is to just constantly going back to that when there's some new news out, look at those premises. And all the other good stuff, go for a walk. Don't do it when you're emotional, because if you're emotional, you're going to catastrophize and your probabilities will be 95% we have a Great Depression or something. All that good stuff.
I mean, to be a bit more specific, so because I've thought about this a lot, where it's hard sometimes to know if you have made a mistake or if it's, due to bad luck or some other circumstance. But in the book, it's quite easy to see where the Superforecaster they put like a probability of a forecast, and then they update that as new data points come in. So, I mean, practically, do you do that as well? Do you have like an investment thesis and you put like, okay, I think this will happen with a 60% probability, and then new data points come in and you update that as you go? Or how do you make that practically? And how do you know for sure that you've done a mistake or not?
Yeah, that's correct. So that's basically what we're doing. So we have it build a little system. So you basically put a probability weighting out of 100 on whatever the forecast is, and then that calculates a Brier score for you over a period. I think that the balance with all this is you want to have it light enough that you actually want to use it all the time, with like robust enough that it's good and useful. But yeah, that's I think the simple way to do it. It's just breaking down taking those premises and putting them in, and yeah, with some software like we use Notion a lot, but there's a lot of other stuff that you can use where you can set a reminder for a date to review that, and then value that whether you got that correct or not, and that feeds into a Brier score. So yeah, that's basically it. Yeah, that's what we're trying to do. But it's again, if anyone's listening to this and interested in how they approach it, that I think is the interesting challenge, because a few of the challenges with investing that make it so hard as a deep practice thing is the delay in feedback loops. So we might be able to forecast some of these short things, but a lot of the other ones are many years. So I guess we'll see. We'll see whether we've been doing this for a couple of years now since Maven launched, how much our Brier scores improve over time and where the gaps are. But it's a different endeavor. You get much longer feedback loops, and there's much more randomness in there. But again, that's similar to super forecasting. So that's part of the challenge these guys had as well when they're trying to predict political events. They found that they could go out to about 18 months. So I think it's just around finding things you can forecast in that kind of range, and making that each year. Might make another forecast of, even if it's cash flow or revenue or something like that, or users, and then weighting that. I've particularly found it good for the no's. Like that's because you say no to a vast amount more businesses than you say yes to. So that is always a good reminder. Get a little notification to check what you thought a year ago and were you right or wrong. And you can't do it based on the share price. We try to do stuff based on the share price as a way of it summarizing, but it just gets so insanely messy so quickly, because if you had anything based on share price this year, it's going to be pretty affected by what's going on in the world. So yeah, I think forecasting fundamental things that you can track is the way to go.
So in the background, I can see you have a poster with the text "Man in the Arena." Can you talk a bit about this?
Yeah, it's one of my favorite quotes. Is an Australian artist, actually, Zen Pencils, who does these kind of motivational quotes. But it's one from Theodore Roosevelt. It's not the critic who counts. The credit belongs to the man who's actually in the arena, whose face is marred with dust and sweat and blood. I won't go the whole quote, but basically, I think it's a good motivation for investing. You constantly are dealing with criticism, whether it's a market or whatever else, and just focusing on people that are actually getting out there and doing it. And frankly, we have the easy job as investors. We get to invest. There's a lot of CEOs out there in the real world doing the grind. So yeah, something to deal with these wild markets at least.
So Matt, I mean, you mentioned a few books already, and I mean, we're always curious to get new ideas on books to read. So first, how do you allocate your time between reading and practicing the art of investing?
I am just constantly haunted by all the books I haven't read. I was working from the library yesterday, and just looking up and just constantly walking over to the bookshelves, trying to think of things I want to read. So I don't think I'm a particularly fast reader. I think I absorb a lot when I do read, and I'm constantly kind of putting a book down to stop and think about it. I don't really have the balance, I guess. It's just, whenever you have spare time, I think it's interesting to read. I try and avoid having things in my life that distract from it. So I have limited times that I'm allowed on Twitter and that kind of thing with my computer setup. So I don't think it's an easy. There's no golden bullet. I'm not a big believer in speed reading. I'm a big believer in comprehension. There's times where I tried to read, as many books as I can, and you can put up some numbers, but now I'm much more about absorbing and thinking through the few that are impactful. in terms of other books that influenced me a lot, I think The Talent Code was a big one, which is a pretty simple book about kind of deep practice. Greatness isn't born, it's made. Here's how is the byline, which is pretty attractive. I read that early. So that was one. I think for investors, Deep Survival, which I don't know if gets a lot of play, by Lawrence Gonzalez, is a really great book. It's basically stories of people who have survived like horrific incidents, and their tools. I think that's, again, a great one for psychology. The Dow Jones Averages is a pretty not super well known investing book about kind of whole brain thinking, so combining the right brain and the left brain. We don't need to get into all that now, but I think that's a one that's very underrated and
next episode
and very useful.
I mean, it's perfect that you mentioned this a bit underrated book. I've heard about the Deep Survival, but not the other, so it would be good to look up.
Yeah, we can do an episode in next year or so.
Yeah, sounds good. I look forward to tuning in.
You also mentioned Rich Dad Poor Dad in the beginning as a book you would not recommend. Why is that?
I guess I might recommend it to a young person to get them interested in it. It has a lot of bad advice in there as a downside, but it's quite emphatic, and it just changes the way that I thought about the world. At least I was we grew up with not a lot of money. My parents grew up with very little money, and so I was always interested in saving, but I never had this idea of business as like a driver. I wanted to impact the world. I kind of saw that after reading that, saw it as the way to do it. But it just kind of it's got a lot of advice that sounds kind of good, but it's not great financial advice. I guess I'd put it that way. There's some stuff in there that's good, and it reframes you to think about wealth in a good way. But the specifics of it, I think there's some questions that I'd have about the way that what it says. But that like framing of how to think about things, I think it's valuable.
I actually read that at an early stage as well, and I think for me it acted as a spark. I mean, I fully agree on what you say, but it actually at that time it really helped me get going.
100%. I read several. I read like 8 of his books after that. Like it was definitely like the spark that started things off. So it's just that, yeah. As I got on, I was like, oh, actually, this thing, like, is this really, yeah. I think that's what you need first is a spark, right? You need to see that you can do it, and that's 100% what it's good for.
And when it comes to super forecasting, I'm curious if there are any things, or many things, I guess, but how do you use it in your private life?
Private life. I haven't mentioned this publicly before. I bet on Donald Trump winning the election at a 10 to 1 odds when it was pretty early on. I just find it all fascinating. I try to think about things probabilistically. So yeah, I guess that spills over into private. I don't know if you count that kind of betting as like a private life thing. I try to think about outcomes. That's probably the main thing, is thinking probabilistically. I mean, all this stuff, it's like all the Buffett and Munger advice, right? It does make you kind of a better person, a lot of it. So if you can be, cautious and thoughtful and all those things, I think it's good.
Have you thought about joining the super forecasting team?
I have thought about it a little bit, but yeah, it's not. Yeah, I've dabbled with one. There was another one that was more open that you could easily kind of sign up for, and some public things. So yeah, I did take part actually. I think they had an open super forecasting version that I took part in for a while. So yeah, but no, I guess my obsession, like you need to be obsessed with that to be really good at it. My obsession is the market. So I didn't want to be thinking about the political outcome of whatever, would a leader still be there in 3 years? I mostly wanted to think about investing.
And another question that I want to ask you is, because in April this year you posted a great question on Twitter that stayed in my mind, and you wrote, without thinking too deeply about it, what fiction book had the greatest impact on how you think about business, investing and life? So I'm wondering if you got some good inspiration there. Yeah,
I've got a good list there. I think previously I'd massively over-indexed on nonfiction. I've kind of been kind of an ambitious guy and thinking, this is just wasting time hearing other people's stories. And I'd started to come around a bit. And I now think it's really useful. I particularly like mixing in like a fiction every couple of nonfictions or something like that. Because what I love about it is the ability to expand your horizons. So, well, for what I do, I like sci-fi. Like some of the science fiction stuff can just blow your mind. I think Rainbow's End for how to think about augmented reality and what's coming is a really great sci-fi book. But just, yeah, it gives you an ability to put your mind in someone else's mind in a way that's hard to do in other genres or styles. And so, yeah, I got a lot of good ones out of that. But I think you kind of live the experience in a fiction book in a way that nonfiction authors often struggle to do, and that's incredibly valuable. I'm more coming to the view that we're, as a society and as investors, over-indexed on kind of what you might call left brain, like analytical thinking, and we suffer from the absence of that whole picture, connective, what's often called right brain. Doesn't matter which hemisphere it happens in, but that style of thinking. And I think that fiction is a way to bring you into that. It gives you the whole picture. It's not just a bullet point list. And so, yeah, that's why I think it can be really valuable.
Matt Joass, thank you so much for coming on Investing by the Books podcast to share your thoughts and insights on the book Superforecasting and how to apply it as an investor. Do you want to add something more before we finish up here?
No, I guess thanks very much for having me. If anyone is interested in this and how they apply forecasting to their profession and what they do, or just mastering investing, we're very open to working with other investors. Our driving force is to master the craft, and we'd love to swap notes or hear from other people about how they do that, how they think about deep practice in investing. These are all pretty hard problems, as we touched on in this pod. So yeah, feel free to reach out. I guess you can hit me up on Twitter at Matt Joass, or on LinkedIn, or however else people want to reach out. I'm keen to chat.
Perfect. We'll put that in the show notes. Thank you so much.
Thanks very much for having me.
Thank you, Matt.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.